What is the best real estate investment market? What should you look for? Today, we're making a case for why we think Atlanta, Georgia is the best investment market ever. Just kidding. But we are going to explain what we look for in a market, and we'll be using Atlanta as a case study.
We like to take a look at the job growth and the population growth in each of the markets that we invest in, because that shows us where people are going, and where people go, that's typically where jobs go, and therefore our residents who are living at our property will have a higher likelihood of not only maintaining good jobs, but having good paying jobs, and that'll allow them to pay their rent.
I got something in my eye. You pick a market that is always growing in population and growing economically with jobs, you're likely to be more protected on a downturn or during a depression.
Atlanta is one of the hottest markets when it comes to real estate, and we love it so much because there are so many different industries seeing a growth in jobs. The tech industry, we have Amazon, Apple, Microsoft, all leasing up office space downtown and in Midtown as well.
Alright, now let's talk about stability. Economic and political stability, that is. These factors can make or break our real estate dreams faster than we can say market crash. So, how do we assess the stability of a market? Keep an eye on economic indicators like employment rates, GDP growth, and major industries in the area.
Stronger markets overall are a lot more recession resilient, so when there is a downturn in the economy, these are less likely to be impacted in a negative way.
Now, real estate market trends and indicators are like the secret sauce that tells us whether an investment market is sizzling or fizzling. But how do we uncover these hidden gems?
To find these trends, you really don't have to overthink it. So what we do is we go online, we do research, look at the census data. It is good to look at data over a long period of time, and then obviously data that's a little bit more recent. So you want to see the trend over, I'd say, decades usually, but then you want to see over the last few years, because some markets have grown more within the last few years.
It's like detective work, but instead of solving crimes, we're solving investment puzzles. And trust me, Sherlock Holmes has nothing on us.
Over the last few years, we've seen rental pricing increase all throughout Atlanta, which has increased the demand for affordable rental housing in Atlanta as well. So we're seeing Midtown, Buckhead, north side of Atlanta kind of increase significantly in pricing for rent. That pushes other people either south or in outskirts of Atlanta that are more affordable.
We utilize powerful tools for data analysis. This way, we'll uncover insights that others might miss. Remember, knowledge is power, and with great power comes great real estate returns.
Whenever we're doing our research, Google is a great tool, but we personally use CoStar, which is obviously a little bit more expensive of a paid service to get that kind of demographic data as far as median household income, just because that will give a good indication of the demographic there and if they can or cannot afford the potential rent that we're looking to increase to. 50,000 is kind of what we look for.
Understanding the demographics and renter profile of a market is another crucial piece of the puzzle. After all, we need to know our audience, don't we?
On this trip to Atlanta, we've actually toured a lot of different properties. So one property was 88 vintage, so 1988 it was built, different demographic than another property that went to see that was 72 vintage. Now that one newer property had a median household income of about 60,000, whereas the other older vintage had a median household income of about 40,000. More than likely, the higher income is more attractive because of the fact that they're more likely to be able to pay the rent. They're more likely to have a more affluent job, meaning that if there's an economic downturn, they'll be able to still pay the rent.
Evaluating potential risks and opportunities is like playing real estate chess. We need to be 3 moves ahead. So, what risks should we be aware of?
You have to make sure to see that the market is not too small and that people are not leaving. And the reason that these are important is because if there's less people, that means that there's less demand for rental housing. Another reason is if people are leaving, meaning that jobs are likely leaving.
Our primary market is any market that has 5 million people or more. A secondary market is any market that has 2 to 5 million people. And then anything under 2 million in population is considered a tertiary market. It's easier to get financing from a lender on a property that's in a primary market because it's less risky for them as lenders.
Next up, landlord-friendly states. These are the places where eviction nightmares become mere bedtime stories.
At the absolute worst case, if a resident isn't paying and they're not taking us up on any of the other alternative solutions that we provide our residents, then we unfortunately do have to evict. If that comes to that point, then we like to have a government in place wherever we're investing that is going to be able to work hand in hand with us to ensure that it's a smooth process. Now, in the South, specifically in the Southeast where we invest, we consider those landlord-friendly states, meaning they typically lean towards the owner of the property.
Also, pay attention to regulations on a county level, not just the state.
As we see here in Atlanta, in some counties, it's more difficult to start the eviction process and complete the eviction process versus other counties where it's easier and a lot quicker.
And hey, don't forget the site visit. Sometimes you gotta go beyond the pixels and experience it firsthand.
I'm sure you guys have been to places where it looks like there's nothing going on, places run down, it looks like people are not even living there, it looks like a ghost town. So you want to make sure you go out and see it and make sure that that's not where you're investing.
Car.
So you want to see buildings being renovated, buildings being built. You want to see sidewalks coming in. You want to see government spending money on parks, new houses coming up, because that means that people are likely moving there. These developers do their own due diligence to see migration in order to be able to sell those homes.
At the end of the day, where we invest is more than just numbers and neighborhoods. For us, it's about the people we're providing affordable housing for and the communities our properties impact. Cash flow and profits are the icing on the cake.